Welcome back. Joining us for a look at the day's markets action is Faheema Adia from Momentum Securities. Faheema, lovely to have you on with us today and Happy New Year. Now, global markets started off the week pretty mixed as traders await key economic releases out from the US, as well as that all-important U.S. inflation print. Now, with the caution somewhat prevailing, what have you made of markets action so far this year?
Afternoon, Toleng. Thanks for having me. Yes, so we've been seeing some mixed numbers and in the markets this morning. It's also been on the red side coming out of Europe. So we did see those non-farm payroll numbers come out of the US on Friday, which came in higher and stronger than expected. And then we also saw that wages increased more than what was expected. So these are showing signs, Ntoleng, that the US labor market is actually still quite resilient and wages are still on the rise. So that's kind of sending a signal that, if this doesn't come under control, then inflation could be stickier than what the market initially expected towards the end of last year. So I think that's been having a bit of a negative impact on markets today, and that's what we're seeing at the moment. And like you said, we're also looking ahead for key data releases this week coming out of the US. Inflation numbers are expected to come out there. Also expecting a slightly higher reading there month on month. But yeah, all in all, I think the market will be keeping all eyes on the data to see when it's going to be most likely for the Fed to start cutting rates.
The caution, of course, putting a halt to that Christmas rally we saw towards the end of last year. This, of course, was mainly driven, that rally rather, was mainly driven by the prospects of looser monetary policy this year. Now, with many analysts penciling in rate cuts by the first quarter. With everything being said and the caution, as I mentioned, still prevailing, do you think we're going to see those cuts within the first quarter of the year? Or are traders simply just getting ahead of themselves?
Yeah, I think in our view, they were looking for rate cuts as early as March. Like you said, there was that end of year Santa Claus rally and the markets were pretty strong, but it's giving back some of those gains because they've now realized that maybe the market was a bit too optimistic in terms of the rate at which inflation would go down. And, we've had the Fed repeatedly say that they will look to the data and be cautious in terms of rate cuts. So they're not going to do it quickly and aggressively if we're still seeing signs that inflation is quite sticky, which could be something we've seen now in that Friday non-farm payrolls data. I mean, we're seeing that strong labor market, we're seeing wages still increase. So in our view, we do think inflation will probably come off, but it's not going to be as quick as the market had expected. We're probably looking for interest rate cuts to properly get started in the second half of the year, I would say, as opposed to, the first.
So the Fed, very data dependent, as you've mentioned. Let's continue that conversation around data and look at the kind of releases we've been seeing across the Atlantic. In Europe, we had Eurozone retail sales declining in November, with Germany being the worst performer of the bloc's major economies. Sales on that end declined 2.5%. Been a pretty mixed picture on that front as well, because we had German exports rise more than expected in the same period. Now, this does suggest that economy hasn't fully recovered, Faheema. What's your sentiment around Europe and whether you expect to see somewhat of a rebound as we move forward into 2024?
Yes, like you said, it's been a bit tough over there. Sales have been under pressure. We've seen retailers also under pressure. It's not the sales one would have expected to come during the December period, unfortunately, which points to the fact that consumers in Europe are under a lot of pressure. Even though inflation has started to cool, there's still pretty high interest rates there, and there's still lingering inflation. So we do think that once rates are cut, that will help the economy to recover. So we could probably look for rates to be cut there also, I would say, in the second half of this year. And once that's done, then we'll see some recovery and hopefully some growth in that economy. But for now, yes, things I think are quite tough at the moment. And we do need to see some rate cuts for the consumer to be in a better position.
Before I get your stock pick, let's just bring it back home. We haven't had much company news, but there was an update from Life Healthcare. It updated the market on the progress of its disposal of that UK Business Alliance Group. Let's just talk about that deal. I mean, yes, shareholders are in for big returns once it's completed, but surely Life Healthcare ditching its offshore operations at this point, where we're seeing progress with the NHI bill, should be a cause of concern, right?
Yeah, so I think, from a market point of view, like you said, shareholders were happy with the deal given the price that they managed to sell it at, and the rationale for it was that they want to use some of the cash to offset some debt and to grow in other markets, and to also return some of that cash back to shareholders, which shareholders are usually happy with too. But yeah, like you said, we do have a lot of risks and local challenges in South Africa, the NHI being one of those. So it would be good to see them, diversify into other markets. And yeah, I suppose they did have a good business there in the UK with Alliance Medical. So we're hopeful that they use this cash as an opportunity to grow in other markets, given the headwinds we're facing this side.
All right, Faheema, let's get your stock pick. It is the first one for 2024.
Yes, so my stock pick is Absa. So if we look at the current price and valuation, we think Absa is well placed to benefit from the upcoming rate cuts in the country. It's trading at a lower forward PE in comparison to both its international and local peers. We are expecting earnings to grow steadily through 2024 and 2025, with the dividends expected to also increase in the next year. And if we look at the Africa regions, a lot of revenue and profits have been coming from there too, particularly from Ghana and Kenya. So it's a good source of revenue diversity. And we think this is definitely one of the better banks to have in your portfolio at the moment.
All right, Absa is what you're dipping into. Thanks for your time and your insights today, Faheema. That was Faheema Adia from Momentum Securities.